Okay, so trade recap of May 1, 2026, Friday, so yesterday. Basically, I do journaling videos just so that we can always go back to something and learn from it. And I do believe that journaling is really important, such a crucial part of our trading journey as well. And I encourage you, each and every one of you, if you want to take this trading thing really seriously, is to actually journal your trades. The way I journal is I do video journaling. This is how I do it, but some people prefer it writing, right? So, but yeah, trade recap of yesterday's trade. Total of 2 wins, 2 trades, 2 wins. Praise the Lord. It was a really good day. It's a really good week, and then ended the week green again for 6 weeks straight. Just remember, guys, winning doesn't mean anything. Getting funded doesn't mean anything. Getting payouts doesn't mean anything. What matters most in these markets is how long you will last. It's a game of consistency. That's the most important part. Is to be consistent, is have the same strategy, the same repeatable model every single day, not breaking rules, following rules, having discipline, being patient every single day almost right at the same time, every single day, doing the same thing over and over, and that's how you last long in these markets, from my experience, okay? And it's been working well for me so far. So, recap of yesterday's trade. We have, first thing I saw was an SMT divergence. Okay, so basically SMT divergence is when two correlating assets, ES and NQ, where NQ takes out a high. In this case, NQ takes out a high, but ES fails to do so. You see, ES failed to take out this high, but NQ was able to take out this high. So that's an SMT divergence, which tells us that there's a possible trend reversal happening anytime soon. Possible trend reversal. I didn't go over SMT divergences yet, but it's a bonus. It's not crucial. It's not important. It's not priority. But it is a bonus, and it is good to know. I used SMT divergence just because we didn't have like a higher time frame fair value gap where we would normally look for a price to reverse. Okay. And after that, I noticed that we were getting this V-shaped reaction and started wondering why. I realized that we swept this internal liquidity over here, so we had a liquidity sweep. When we swept that, we had this fair value gap, okay? When this fair value gap, then after this fair value gap, we had a new swing high. We had a new high form in the market. And after that, a bearish candle moved. This fair value gap right here then gets inversed by this candle, meaning that there's a possible temporary change in order flow. An inverse fair value gap, which is an IFVG, basically just warns us that there is a possible temporary trend reversal. Okay, and then CISD confirms that temporary trend reversal. CISD is the last swing low before the new swing high. Okay, Raven. So CISD is the last swing low before swing high. Okay, because remember, when you look at market structure, in a bullish market, Raven. So when you look at market structure, we go up, we go down, up, down, up, down, up, down, up. So that is a bullish trend, okay? But when price breaks below this last swing low over here, before this last swing low, and price closes and breaks that is our change in the state of delivery. That is our change in the state of delivery. Similar to break a structure, but we're not gonna focus there. We're gonna focus on the change in the state of delivery, that only. Okay, so yeah, that's that. So when price broke that last swing low, that is our change in the state of delivery. And I entered at the retest of that change in the state. I drew a line here and I put a limit order. That's when I entered. So when my order got filled, I put my stop loss over here right at the all-time highs. And my take profit, my target is always imbalances. That is my priority. If I don't see any imbalances, okay, I could probably go to external liquidity, but my priority will always be these imbalances over here. Almost all the time that markets will hit it. And so you can see that's where market bounced and consolidated, because remember, there's only three reasons why the market moves. Fill imbalances over here, fill imbalances, hunt liquidity, which is external or internal, sell side, buy side, or news. There's only three reasons why the market moves, and based on those three reasons is how we find our targets, is to fill out these imbalances over here. Okay, as you can see, price reacted and then bounce off from these imbalances. Precision, this is like precision trading, very precise. Just follow the model every single step, learn it, practice it over and over again. It will reward you, I promise.